The answer to this debate has been publicly available since 2019. A team of 5 economists, Jordà, Knoll, Kuvshinov, Shularik, and Taylor, published a paper in the Quarterly Journal of Economics called The Rate of Return on Everything, 1870 to 2015. They analyzed 150 years of returns across 16 countries: stocks, bonds, bills, and for the first time ever in an academic dataset of that scale, housing. The results should have ended this argument permanently. It didn't. Because the real answer is so uncomfortable that neither the real estate industry nor the stock market industry wants you to hear it. Both sides cherry-pick from this study, both sides leave out the part that dismantles their pitch, and the part they leave out, the variable buried on page 47 of the working paper, is the one that actually determines which investment wins for you, personally, in the next 10 years. It has nothing to do with returns. We'll get there, but first, you need to see the math that both sides are hiding. There's a number that Robert Shiller, Nobel laureate, Yale economist, co-creator of the Case-Shiller Home Price Index, has been trying to get Americans to understand for over 20 years. He put it in his book, Irrational Exuberance. He's repeated it in interviews, lectures, and congressional testimony. The number is this. Between 1890 and 1997, the inflation-adjusted price of American homes was essentially flat. Not declining, not booming. Flat. Over 107 years, home prices in real terms showed almost no sustained appreciation at all. They tracked inflation, give or take a fraction. The Case-Shiller Index, normalized to 100 in 1890, was hovering near that same baseline more than a century later. Most people hear that and reject it immediately because it contradicts everything they've been told by their parents, their real estate agent, and the closing attorney who handed them a pen. Their lived experience says otherwise. They bought a house for $180,000 in 2003, and it's worth $410,000 now. That feels like a fortune, but inflation alone accounts for roughly half that gain. And the remaining appreciation? It arrived almost entirely in 2 bursts, 1998 to 2006 and 2012 to the present, not as a slow, steady march. A 29-year-old nurse named Claudette, living outside of Raleigh, told me she bought her first home in 2021 because her mother told her, real estate always goes up. Claudette's mother bought in 1994 for $112,000 and sold in 2019 for $298,000. 25 years, a 166% nominal gain. In inflation-adjusted dollars, that gain shrinks to roughly 65%. Annualized, about 2% per year in real terms. The S&P 500 over the same period, 1994 to 2019, returned approximately 10.2% per year with dividends reinvested, according to data compiled by DQY-DJ using Robert Shiller's dataset. Inflation-adjusted, that's roughly 7.5% per year, 2% versus 7.5%, over 25 years. On paper, it's not even close. So why does every family reunion still produce an uncle who insists the house was the best investment he ever made? Because the uncle is measuring something different than he thinks he's measuring. Here is where the Jordà Study drops its first bomb. Across 16 advanced economies from 1870 to 2015, the average annual real return on equities was approximately 7%. The average annual real return on housing was also approximately 7%, roughly equal. That finding shocked the economics profession. It challenges the entire narrative of stock market superiority. If housing returns match equity returns, and housing returns are far less volatile, with lower standard deviation year to year, then the efficient market crowd has a serious problem on its hands. But here's what the real estate cheerleaders don't tell you about that 7% figure. The housing return in the Jordà dataset includes rental income, not just appreciation, but the imputed or actual rent that a property generates. Strip out rental income and look only at price appreciation, and the long-run real return on residential real estate drops to roughly 1% to 2% per year in most developed nations. That's the gap between what your uncle thinks happened and what actually happened. He remembers the sale price. He doesn't count the rent he never collected because he lived in the house. He doesn't subtract the $187,000 in mortgage interest he paid over the life of the loan. He doesn't add up the property taxes, roughly $4,000 per year in most states, or $100,000 across 25 years. He doesn't tally insurance premiums, which have surged nearly 70% since 2021, averaging between $2,800 and $3,500 annually by 2025. He doesn't track the new roof in 2011, the HVAC replacement in 2016, the water heater that burst on Thanksgiving. He doesn't record the lawn care, the gutter cleaning, the termite inspection, or the $14,000 kitchen renovation he did to add value before listing. All of those costs are invisible in the sale price. They are subtracted nowhere. They exist only in receipts he threw away years ago. Bankrate's 2024 Hidden Costs of Homeownership study found that the average American homeowner pays $18,118 per year in costs beyond the mortgage: property taxes, insurance, utilities, and maintenance. On a home valued near the national median of roughly $400,000, that's 4.5% of the home's value annually in carrying costs alone. So the house appreciates at 2% per year in real terms, while costing 4.5% per year to own. That's a negative real return on the most celebrated asset in American culture. Breathe. Now, before you close this and go buy index funds, the stock market has its own confession to make. The S&P 500's long-term average annual return of roughly 10.4% nominal, which drops to about 6.5% after inflation, according to data through April 2025, compiled by DQYDJ, assumes one thing that almost nobody does. It assumes you never sold. Not during the dot-com crash, when the S&P lost 49% between March 2000 and October 2002. Not during the financial crisis, when it dropped 56.8% from its October 2007 peak to the March 2009 trough. Not during the COVID flash crash in March 2020, when portfolios vaporized 34% in 22 trading days. Not during 2022, when the index fell 18%, while your grocery bill rose 11%. The Morningstar. Mind the Gap study, published annually, measures the difference between the returns a fund delivers and the returns its investors actually receive. The gap exists because real humans buy after prices rise and sell after prices fall. According to Morningstar's 2024 report, the average investor earned roughly 1.1 percentage points less per year than the funds they owned over the prior decade. On a $100,000 portfolio over 20 years, that behavioral penalty costs approximately $70,000 in lost wealth. The stock market's 10% return is like the speed limit on the Autobahn. Technically available, almost nobody sustains it. Deshawn, a 44-year-old logistics coordinator in Memphis, started investing $400 a month into a total market index fund in 2015. By February 2020, his account had grown to $31,200. On March 16, 2020, it was worth $22,400. He moved everything to a money market fund. By the time he moved back into equities in November 2020, the market had recovered completely and was hitting new highs. His round trip, panic sell, wait, re-enter, cost him roughly $8,700 in missed gains that he will never recover because those gains would have compounded for the next 25 years of his life. Deshawn isn't irrational. Deshawn is human, and the stock market's historical average doesn't include a line item for being human. So here is the actual scorecard, stripped clean. Real estate, measured purely by home price appreciation after inflation, returns roughly 1% to 2% per year nationally. Adding imputed rent, the value of living in your own property rather than paying someone else, the total return approaches 5% to 7% depending on the period and country. But out-of-pocket carrying costs eat most of that rental yield if you're an owner-occupant. As an investment property, the returns can be higher, but so are the carrying costs, vacancies, and management headaches. Stocks, measured by the S&P 500 total return after inflation, deliver roughly 6.5% per year over the long term. But behavioral drag, the gap between fund returns and investor returns, pulls the real-world figure down by 1 to 2 percentage points for the average person. Here's the sentence that will make both industries furious. After adjusting for costs, behavior, and inflation, the average American's actual long-term return on their house and their stock portfolio are uncomfortably close to each other. Both land somewhere in the neighborhood of 3% to 5% real, depending on discipline. The debate is a distraction. It always has been. The variable that separates wealth builders from everyone else was never a set class. And this is where we get to page 47. The variable is leverage, and it's one-directional. When Claudette bought her home in Raleigh for $340,000, she put down $20,400. 6%. Her mortgage covered the rest. That means she controlled a $340,000 asset with $20,400 of her own money. If the house appreciates 3% in 1 year, a gain of $10,200, her return on invested capital is 50%. 50%. No stockbroker on earth is offering a middle-income nurse 50% annual returns on $20,400. But a mortgage lender did it without blinking at a fixed interest rate with a 30-year repayment window, and the government subsidized the arrangement. The mortgage interest deduction, the $250,000 capital gains exclusion for primary residences, the FHA loan program, Fannie Mae, Freddie Mac, an entire federal infrastructure exists to make leveraged real estate investing available to people who would be laughed out of a commodities trading floor. The FHA will insure a mortgage with as little as 3.5% down. That's 28-to-1 leverage on a federally backed asset. The average margin account at a brokerage gives you 2-to-1. Maybe. This asymmetry, cheap, easy, socially acceptable leverage for housing versus expensive, restricted, stigmatized leverage for stocks, is not an accident. It's policy. It has been policy since the National Housing Act of 1934, and it is the single largest structural advantage real estate has over equities. Not the return, the access to other people's money, but leverage is only half the mechanism. Here's the other half, the part the real estate industry doesn't want you to examine. A mortgage is a forced savings account wearing the costume of a debt. Every month, a portion of Claudette's $2,180 payment goes toward principal. She cannot skip it. She cannot redirect it. She cannot wake up one Tuesday and decide that this month she'd rather spend her principal payment on flights to Lisbon. The bank does not care about her mood, her impulse control, or whether Mercury is in retrograde. The payment happens. Compare that to Deshawn's $400 a month index fund contribution. It's voluntary, it's adjustable, it's easily paused, reduced, or redirected. In November 2019, Deshawn skipped a month because his car needed brakes. In January 2020, he skipped another month because Christmas spending got out of hand. In March 2020, he stopped entirely and pulled his money out. Nothing stopped him. No bank called, no system intervened. The Bureau of Economic Analysis reported the U.S. personal savings rate at 3.9% in March 2025, down from 4.6% a year earlier, down from 5.2% at the start of 2024. In a country where the median household income is roughly $80,000, that's about $3,120 saved per year, enough to fund approximately 2 months of emergency expenses and nothing more. Americans don't save. Not because they can't do math, because nothing makes them. A mortgage makes them. A 30-year fixed-rate mortgage is the only widely available financial product in America that converts undisciplined income into long-term equity on a schedule that does not rely on willpower. The house isn't the investment. The payment structure is. This is the dirty secret. Real estate's greatest advantage over stocks is not the return, not the leverage, not the tax benefits. It's the behavioral handcuffs. In 1995, a behavioral economist named Shlomo Benartzi and his colleague Richard Thaler, who would later win the Nobel Prize in Economics, published a paper called Myopic Loss Aversion and the Equity Premium Puzzle. Their core finding was that investors evaluate their portfolios too frequently, and because losses sting roughly twice as much as equivalent gains feel good, a principle from Daniel Kahneman's prospect theory, frequent evaluators take less risk and earn less return. Homeowners almost never check their home's value. They don't open an app at midnight to see if their house dropped 2% since dinner. They don't get a push notification every time a comparable sale closes below their estimate. But stock investors check constantly. A 2023 survey by the Financial Industry Regulatory Authority found that 40% of investors with brokerage accounts checked their portfolios at least once a day. Every time they check, the probability of seeing a loss increases, not because the market is losing more often, but because in any given hour or day, the probability of a negative return is close to 50%. Over a year, stocks are positive roughly 73% of the time. Over a single day, the number drops to roughly 53%. Over a single hour, it's a coin flip. The more you look, the more pain you see. The The more pain you see, the more you act. Every action driven by loss aversion costs return. The house, sitting quietly in the background, doing nothing, appreciating at its unremarkable pace, compounds. Not because it's a better asset, because its owner can't touch it. There's no sell button on the kitchen counter. There's no push notification at 6 a.m. telling you your hallway lost $4,300 in value overnight. That is the finding buried in the Jordà data that neither side wants to publicize. Housing returns match equity returns globally. Not because houses appreciate faster than stocks, but because homeowners are structurally prevented from sabotaging themselves, while stock investors are structurally invited to. So, which one wins? The honest answer, the one that costs financial advisors commissions and real estate agents listings, is that the winner is whichever one you won't interfere with for 25 years. If you're the kind of person who can set up automatic monthly investments, never look at the balance, never sell during a crash, never skip a contribution, and never touch the account for a quarter century, stocks win. The math isn't close. The S&P 500 6.5% real annual return crushes housing's 1% to 2% in pure appreciation. Even factoring in leverage, even adding the mortgage interest deduction, the disciplined stock investor builds more wealth over time. And she does it with total liquidity. She can move, change jobs, relocate to another country without selling an illiquid asset in a down market. But that person, the perfectly disciplined, emotionally inert, never flinching index fund investor, is a statistical ghost. She barely exists. According to J.P. Morgan Asset Management's 2024 Guide to the Markets, the average investor held a fund position for roughly 3.4 years. Not 25, not 15, 3.5. The average holding period for a home, by contrast, is roughly 13 years, according to Redfin data from 2023. Homeowners stay almost 4 times longer. Not because they're more patient, but because selling a house requires a realtor, a listing, a showing process, closing costs, and 60 to 90 days of logistical agony. The friction is the feature. Giovanna, a 37-year-old operations manager in Denver, did the math in 2019. She decided not to buy a condo and instead invested $2,800 a month, what her mortgage payment would have been, into Vanguard's total stock market index fund. In the first 2 years, her plan worked beautifully. By March 2022, she had accumulated $78,400, and the market was cooperating. Then rates spiked, inflation bit, and the S&P shed 25% between January and October 2022. Her balance dropped to $61,000. She didn't sell, but she did something almost as costly. She paused contributions for 7 months. Those 7 months of missed $2,800 deposits, $19,600 in contributions that would have bought shares at discounted prices, represent the highest value purchases she will never make. Meanwhile, her friend Adriana, same age, same income, same city, had bought the condo in 2019 for $350,000. Adriana's mortgage payment went out every single month regardless of what the market did, what her mood was, whether she'd read a terrifying headline about a recession. She never paused. She never could. By 2025, Adriana had accumulated roughly $67,000 in equity through principal paydown alone, before counting any appreciation. The condo itself had appreciated approximately 18% since purchase, based on Denver Metro Case-Shiller data, adding another $63,000 in paper wealth. Giovanna has $92,000 in her brokerage account. Adriana has $130,000 in home equity. Both women earn the same salary. Both women are intelligent, financially aware, and doing their best. The gap isn't intelligence. It isn't the asset. It's the architecture, the difference between a system that requires daily discipline and one that enforces it automatically. One more layer, because you deserve the full picture. There's a concept in behavioral finance that Thaler calls a mental account. People assign different rules to different pots of money. Home equity sits in a mental account labeled untouchable. Brokerage accounts sit in one labeled available. That label alone changes everything. Adriana has never once considered tapping her home equity to fund a vacation, but Giovanna transferred $4,200 from her brokerage account to cover an unexpected dental bill and a friend's wedding in the same month. The National Association of Realtors reported in April 2026 that the median existing home price was $417,700, marking the 34th consecutive month of year-over-year price increases. That steady, unremarkable appreciation compounds inside a mental account that most Americans treat as sacred. The same $417,700 in a brokerage account would be surrounded by sell buttons, transfer options, margin offers, and daily volatility. The money is technically the same. The environment is not. One container has a lock, the other has a revolving door. And here's what makes this particularly painful for anyone who prides herself on being rational. Knowing this doesn't fix it. The behavioral gap doesn't shrink with education. Morningstar's data shows that even experienced investors, people who understand compounding, who've read Benjamin Graham's The Intelligent Investor, who know the math cold, still underperform their own funds. Knowledge without structure is a spectator sport. The question was never which asset class has better returns. The data says they're almost identical over 150 years. The question is, which container will you actually leave alone long enough for compounding to do its work? And the uncomfortable truth is that for most Americans, not the theoretical, perfectly rational investor, but the actual person checking her phone in the Target parking lot on a Wednesday, the answer is the one with a lock on it. Here's what shifted in the last 20 minutes. You came in thinking this was a math problem. 2 columns of numbers, one asset declared the winner. What you found instead is that the math has been roughly settled since 2019, and neither side told you because the answer doesn't sell anything. Housing and equities produce similar long-term returns globally. The difference is not in the asset. It's in the behavioral container the asset sits inside. The next obstacle is this. Knowing the answer doesn't automatically change your behavior. Giovanna now knows she paused contributions during the worst possible window. Knowing that won't prevent her from doing it again in the next downturn, because the impulse isn't intellectual, it's emotional, and emotions don't read research papers. You expected a clean verdict. What you got was something more useful and more unsettling. A mirror. The asset that builds your wealth is the one that survives contact with the version of you that panics, procrastinates, and rationalizes. Every other comparison is decoration. Sit with that for a moment. If the version of you that showed up tonight feels different from the one who clicked play, this channel was built to do exactly that. Subscribe to Aria Invests, not because the next video will tell you what to buy, but because the most expensive financial question you'll ever face was never about the investment. It was always about the investor.